नमस्कार सभी को. This video, as I already told you, that this week I will be completing the fundamentals of partnership. So let's start the very beginning of fundamentals relating to partnership accounting. So how to prepare capital account for partners? So for that you must first know the difference between the fixed capital and fluctuating capital, because these are the only two methods through which capital account of partners are prepared. So as you can see, the basic difference, it's very visible. As under fixed capital method, when the capital is when it is specified in the question to prepare capital account under fixed method, remember one thing: all throughout the year the capital remains unchanged until and unless cash is withdrawn or brought, right? So under fixed capital your capital remains fixed or unchanged for a long period of time until and unless cash is brought or it is withdrawn. Now withdrawn means it is drawing and brought means additional capital is brought. Whereas under fluctuating capital method, as the name says fluctuating, here the capital never remains unchanged. Here the capital fluctuates. Okay. Then the second point you can understand from this written columns, that under fixed capital method two accounts are prepared: capital account and current account or drawing account. Whereas under fluctuating capital method there is only we prepare one account, capital account. Then all the transactions relating to drawings, interest on drawings, commission, commission given to partners, salary given to partners, okay, then the share of profit, share of loss, all will be transferred in current account. And in capital account only you see opening balance is shown and then it is the closing balance is shown, opening and closing balance, right? Whatever the additional capital is brought, it will be recorded in the credit side, and if there is, if any drawings are there, it will be shown under the debit side. Then under fluctuating capital you do not need to prepare two accounts. You all you have to prepare only one account, which is known as capital account. So here all the transactions relating to whatever given to partners, salary, commission, interest on drawings, okay, whatever the charges are being made on partners like interest on drawings, share of loss and profit, everything will be recorded under one account, that is capital account. Then fixed account can never have a negative balance. Remember this. Fixed account can never have a negative balance, because the capital balance always have a credit balance here. You see, under fixed capital you will see the opening balance always there as a credit balance. But in current account, what happens? Here under fluctuating, first you understand the fluctuating. Fixed capital method can never have a negative balance. Remember this. And under fluctuating it can show negative balance, but fixed it will never show the negative balance, but fluctuating can show the negative balance. Now what is the basic difference between current account and capital account? Let's see. So you see here one thing, capital account is similar. That means you follow any method, be it fixed capital method or fluctuating capital method. Capital account is something which you have to prepare in both sides, right? Then another thing to understand here, when capital account is prepared under fixed method, it will only show credit balance. Whereas under fluctuating capital it may have credit balance or it may have debit balance. Remember this. I'm repeating this point. When capital account is prepared on fixed method, when capital account is prepared on fixed capital method, it has only, or it will show only credit balance. In fluctuating capital method, it may show credit or a debit balance. Current account, when you go for the current account, it may have credit as well as debit balance. That means I'm talking about the opening balances. The opening balances given in the question can be in credit or debit, right, for the current account. But if the capital account is given, it should always be showing the credit balance. So there is a difference between capital and current account. From this you can understand, right? Now when capital account is prepared on fixed capital method, it generally remains unchanged from year to year. Whereas in fluctuating capital, it changes every transactions, right? Capital account, both are having the capital account. I'm just telling you the difference. Capital account under fixed capital method, the balance will remain same, intact for many years, until and unless capital is brought or withdrawn. Whereas under capital method, capital account under fluctuating method, it may show differences. It may fluctuate. Now current account is something which keeps on changing with every transaction. So this is the basic difference between current and capital account. So from here we can understand that to prepare capital account we have got two methods, fixed capital method and fluctuating capital method. Fixed capital method follow two accounts, capital account and current accounts. So all the transactions which relates to partners, that means salary is given, interest on capital is given, partners commission is given, everything will be, drawings is there, interest on drawings is charged, everything will be entered in a current account if you follow fixed capital method. And under capital method, all you have to show only the opening balance, which should always be credited in the question. It will always be credited, never debited. And if any additional capital is brought, it will be credited. If capital is withdrawn, like drawings, it will be debited, and the balancing figures your capital account. Under fluctuating capital method, you prepare only one capital account. Here you show the opening balances. Now opening balances can be credit or can be debit. All the additional capital brought will be shown in the credit side. Interest on capital given to the partner salaries, partner's commission will be shown in the credit side. If there is a profit share is there, it will also be recorded in the credit side. Under the debit side, if cash is withdrawn as a drawing, if drawings are being made from the profit, all right. If interest on drawing is charged, it will shown under, it is recorded under the debit side. Now remember one thing, it's a note which should be pointed, that which should be jotted down. The thing is, if the question doesn't mention to prepare capital account by which method, always follow the fluctuating capital method. That means prepare only one account. And here in that you will show everything. And in the absence, this is the first thing you should know. And remember one thing, no current account is prepared if you are following the fluctuating capital method. If you are following the fluctuating capital method, you have to prepare only one account, which is capital account. And if in the question it is not mentioned which which method is to be followed for preparing capital account, always go for fluctuating capital method.